Yeah, you said it there, and I think there is inflation already around. It's just not in the measures that the economic calendar will point to. CPI last week soft. PCE really hasn't done much either. So it keeps the Fed accommodative. It keeps Congress moving forward with new spending bill from last week. So I think it's sort of a Goldilocks of narratives mixing together here right now, because you do have that economic demand that's out there. It's picking up. I mean, you mentioned lumber prices, crude oil is higher. There's a number of commodities across the board in the agriculture sector that are multi-year highs. So the inflation, for all intents and purposes, is already here. It's just not in the measures that the Fed is pointing to right now.
Peter, I'm taking a look at the notes that you sent over, and you said that it's crucial that you lay out your expectations on interest rates, as getting that right will make everything else relatively easy. So what are you expecting on that front? I guess, how high do you expect interest rates to potentially go?
I'm looking for the 10-year to go to 2%. And ironically, I think we're actually going to get a very dovish Fed this week, right? They're going to ignore inflation. They're going to say it's transitory. They really want this economic growth to kick in. And what I think that is going to do is actually cause a little bit of fear again in the 10-year and 30-year part of the curve. So you're going to see yields steepen as people say, whoa, if the Fed's really going to let things run hot, I don't want to own the 10-year at 1.6%. So I'm looking for a backup to 2% on the 10-year, maybe 2.5, 270 on the 30-year. And I think that's going to be a bit of a headwind for some parts of the stock market.
So let me follow up with that, Peter. Do we get a new operation twist? And what would that look like for us average investors? How would that work?
So what the Fed has done in the past is they do an operation twist where they take their balance sheet and they sell some of their short dated treasuries, so the 2-year and in, and then they go and buy 10-year and out, typically in the 20 and 30-year part of the curve. And what that attempts to do is take some, let the front end rise a little bit and keep back end yields contained. I think they will ultimately get to that. There's some talk about them doing it this meeting. I don't think we're there yet. I think they need to see the 10-year at 2% before they start changing their current methodology. I think they're comfortable with yields rising. Again, we were at 190 on the 10-year before COVID started, and we were at sub 4% unemployment. So we can let this rise go on. The Fed's not going to react. That's going to disappoint Treasury markets. And from some of the guests you've talked to earlier today, I think one theme that I've been running with is this is a year where we may see the economy do better than financial assets.
Bill, what do you think it's going to take in order for the Fed to react?
I think Peter made a lot of great points there. One of the things, though, as a trader, that and the futures as well, when you're using leverage, you've got to be sort of ahead of things. And I think last week, although I agree with Peter, I think last week or 2 weeks ago when Fed Chair Powell had said that they're not considering the yield curve control or that operation twist, we already saw the market react a bit. And I think there's been a number of sort of capitulations in the bonds. It may not be totally done. I mean, you see what happened Thursday night into Friday morning when the bond market really cratered. But I think we're closer to the end of the bond market finding a low rather than sort of the onset of it. One of the things I'm looking at and playing on the future side is I'm selling put spreads in the 30-year bond, turning it to a risk reversal with a little more time frame and buying some call spreads. I think that's one of the ways to do that. On the equity side, I've been positioned in the banks. I think the banks are great. Have really been capitalizing on this rise in yields. I think they will continue to. So again, it comes to by being diversified to position properly. But I do think we're closer to the end of or at least a short-term pause in the rise of rates. I've been very bearish on bonds over the last few months. And long term, though, I am a bond bull, and I do think that this has just sort of just been an intermission. 2% could be achieved, but I think that too many people are calling for 2% that we may not quite get there.